I want to start off by saying thank you guys for tuning into my page. This is one of the first videos I have ever done. One of the things I'm going to be talking about a lot of is personal finance, insurance, and investing. I'm actually right now studying for my investment license, and I should be licensed within 90 days. That's my goal, to be actually licensed in 90 days to offer mutual funds and different things like that. One of the things I do a lot of is read. I read a lot of information. I read a lot of magazines on business, like Money Magazine. I love Money Magazine. And I read a lot of books. As you can see behind me, I have a whole bunch of books. Um, those are not even like half of my books. I have like hundreds and hundreds of books I read. One of the best books is Think and Grow Rich. I love that book. Anyway, I really wanted to talk about some insurance today. I was reading an article in my maybe my favorite magazine. This is the Black Enterprise magazine. This is a great magazine. I've been reading this magazine since 2000. That's when I was in the military, and I was reading a lot. Actually, I started writing a book about investing and saving money. I haven't finished it, so that's one of the things I'm kind of working on too. But I started writing a book about for new people, like concepts, the stuff that I know about and I learned about. One of the things I want to talk about today is, again, insurance. And I was reading this article. It's on page 102 of the October Black Enterprise magazine. One of the things this guy talks about is buying whole life insurance. He says that it guarantees 3 to 4% interest, and you don't have to pay any penalties to withdraw your money from here. And he gives an example. He says a policy for $50,000 for I'm reading it. A policy for $50,000 for a 25-year-old in good health will cost $180. At the age of 35, that person would have a cash value of $21,000. Okay, when I read this, I thought, dang, $180 is kind of expensive for a 25-year-old, because I always, when I sell policies, I'm always selling them around 40 or 50 bucks at the most. So when I read 180 for a healthy 25-year-old, I thought, this is ridiculous. And this is a guy. It doesn't say what state he's in. It just says he specializes in insurance. So it sounds like he specializes in ripping people off. But I really want you guys to understand the power of buying term and investing in the difference. First off, just going by age and age alone, I was like, that got to be a problem right here. Okay, I ran the numbers, and I was actually, right before I read this article, I had gave a friend of mine a quote. She's 30 years old, and she wanted $100,000 for her, and she wanted her kids to be covered. Well, for her to get $100,000 at 30, okay, again, in this article, really quick, the person was 25 years old. Let me see if I can show it. I think I have it highlighted. Okay, so you guys know I'm not lying. Let's see if I can show it really quick. I'm trying to get the. You see right here, 25 years. It's not really clear. Let me see. A policy of $50,000 for a 25-year-old. I hope you guys can see that. Okay, if not, go buy the magazine. I recommend buying this magazine anyway because it has really great articles. So go buy the magazine, turn to page 102, and then read. Okay. Anyway, I gave my friend a quote for $100,000. It was $35.87, and her kids. I think she has 2 kids. Both of them will be covered for $15,000 apiece. So that's $30,000 total, just on the kids, and $100,000 on her. It's 36 bucks. So that's gonna save her if she had this policy, what this guy offered. This guy right here. I want you guys to look at this guy. That guy right there. Okay. So if that guy had sold her a policy for $180, and I would have saved her $144, my policy is $36. Okay. And he said that in 10 years, okay, first of all, I have never seen a whole life policy mature $20,000 in 10 years. Never. Okay. Really quick. But if it did, right? We're going to compete with that. If this person put their money into a savings account that grows 3%, which is really low, ridiculous. If they save the money with us, they have about the same amount, about $21,000 in the same 10-year period, but they will have double the insurance and their kids will be covered. With that account, with that plan that guy offering, with the whole life, their kids are not covered and they only have $50,000. After burial, the family will probably have about $30,000 to $25,000. I'm not sure who will take the kids if that person have kids. Um, so that person's family will pretty much be still needing money. Okay, if they put it into like a money market account that grow pretty conservative, a 6% interest rate. Let's just say on average 6% interest rate. That money will be about $24,000. So all doing that is actually beating. Now it's beating the whole life policy. Well, it's already beating it with the face amount, which is what you get in cash. But now your cash account is beating the whole life policy. And if they put it into like a mutual fund and it grows a 12% interest rate, they will have about $33,000 or $34,000 in cash on top of the $100,000. Um, so that policy right there, as our 30-year-old beat their 25-year-old, and your policy, your life insurance usually go up. The older you get, the more it costs, and the less you have. Less you will have in savings because you have to save more. Okay. Then I said, well, if our 30-year-old is beating their 25-year-old, let me run a rate on a 25-year-old. So our 25-year-old, if we just did apples to apples and said, okay, I'm just going to cover a 25-year-old with no family, just a 25-year-old for $50,000. Our $50,000 policy is $16.25. They're paying $180 over here. Uh, I don't know. I wouldn't even know how. I don't know. I couldn't even explain that. If I went into a house and you're paying $180 for $50,000 and you're a 25-year-old, and I tell you you can pay $16 with us and you don't get it, you have a problem. Then I said, well, with that policy, they're gonna have $21,000 in cash. So if we did a 16-year-old, it's $16 and invest the difference. So this is where the buy term invest the difference come into play. If we invest the difference, and let's say they did the same thing, 3%, 6%, 12%. If they put their money, the difference, into a 3% account, it'd be about $23,000. If they put it into a 6%, which is like again the money market account, it's $26,000 or $27,000. And if they went to a mutual fund, which grows about 12% on the average, they have $38,000. So, would you want $50,000 with $21,000 in cash, or you want $50,000 of coverage and $38,000 in cash? Same period of time, same amount of money spent, right? And then in this article, they don't give you the rules of whole life. The first rule is for the first 1 to 5 years on average. Now, some policies it takes 2 years, some it's 3, some it's 4, but on average, the first 1 to 5 years, no money goes to your savings account. Okay, the second rule is once the money starts going into your account, it grows anywhere from 3 to 4% interest rate. Okay, really quick, if you guys want to Google inflation, look up inflation and see how much it is. On average, it's about 4%. So if your money growing at 4%, it's just basically keeping up. It's not really growing. Okay. The third rule is that if you want to use your money or take money out of this account, you have to borrow that money anywhere from 6 to 8%, and that's average. That's on average. Okay, this guy said there's no penalties to withdraw your money. You may not be taxed for taking the money out, but if you have to borrow your money, that sounds like a penalty to me. Okay, the third rule is that they can make you wait up to 6 months before they actually give you the money. And then the fourth rule is that if you have money in your savings account and you die or you pass away, the bank or the insurance company will actually keep that cash, or you can give up the face amount, but you're not gonna get both. Like this example, this guy has or this woman has $50,000 in coverage and $21,000 in life in cash. So if they die, the family don't get the $70,000. They either get the 50 or the 20. So of course you're gonna take the 50 because it's more. But where the 20 go? The 20 goes back to the company. It doesn't go to your family. So you've been saving the money there for really nothing. And if you guys don't believe what I'm telling you, go get your policies, read them, read them very carefully. If you don't know how to read the policy, you can inbox me, and if you live in California and you live in the Los Angeles area, feel free to hit me up, inbox me, and I would definitely go over your policy with you. I'll give you my phone number. We can meet, and I will go over your policy with you. But please stop getting ripped off by these insurance agents that only care about making money and not saving families. Thank you guys for tuning in. I'm going to be sending out a lot more videos. I'm going to try to do as often as possible to keep our community knowledgeable of what's going on and stop people from getting ripped off. Thank you guys again.